cash flow is king for all small businesses. And you would be very wise to lead with cash flow messaging.
Hi, everyone, and welcome to the Payments Strategy Show. I'm Joshua Silver, founder and CEO of Rainforest. We help software platforms embed payment processing into their core product to grow revenue and improve customer retention. I'm here today with a good friend, Itai Damti, who is co-founder and CEO of Unit, who is a market leader in embedded finance. I'm really happy to have Itai join us on the show to share some insights into how embedded fintech can help vertical SaaS companies, including how to sequence fintech products and maximize revenue. Thanks so much for joining me on the show.
It's good to be here.
So Itai, tell us a little bit about your background and what first inspired you to start Unit. How did you actually identify this opportunity in embedded fintech for vertical SaaS companies?
Yeah, so it's thanks again for inviting me. Excited to jam today. I've been a founder for 18 years. Unit is my third company, all in fintech. So I keep going back for the same kind of pain, I guess. I built companies out of Tel Aviv, Hong Kong, spent some years in San Francisco, and I'm based in New York City. So I'm here in the office in Tribeca with the team. What prompted us to start Unit? Was our second company together as founders. I think we looked at the environment around us in 2019, so 6 and a change years ago. We saw that software companies were trusted by millions of people, and they spin those flywheels of data, distribution, trust. They see fund flows in many cases. We saw a new form of innovation in fintech back then, which is what we called fintech 2.0. That's not your typical Venmo trying to, do something that the big banks do, but more companies like Toast or Shopify or Gusto or Uber expanding from their core services of software onto storing money, helping people and businesses spend money with cards, giving loans. And we thought, one, we can see thousands more companies doing it over time. We didn't fully know the extent that, vertical SaaS was going to be an important topic, but we definitely saw how some companies can do it for, nonprofits or construction companies or e-commerce businesses, etc. And I think those companies have a natural leg up and a bigger right to win than the Venmos of the world, because they have those customer relationships. They have the trust, the data, the distribution, the fund flow. They process payments with companies like Rainforest. And they want to extend into more forms of money management and helping their businesses do more with their money. I also thought that the tooling that was available to them at the time was very poor. I mean, you saw some companies like Galileo or maybe some banks with APIs back then, but nothing was complete. Nothing was easy to get started with. And so our goal of turning them into winners in financial services remained. How we do it has changed over the years and evolved, but that's the genesis of the Unit idea. Today we serve over 100 companies and help move more than 60 billion annually across all forms of credit, banking, and more types of money movement.
That's some really, really great scale you've accomplished. You mentioned how you do it has changed. Certainly you've seen the evolution over a number of years. Can you tell us a little bit more about how has the landscape changed, especially in the last few years, and where do you see it heading?
Yeah, so I think, embedded finance when Unit was starting was a very futuristic idea. Even fundraising was hard in 2019, right? Trying to tell people how software companies are going to be more central in all things financial services. I think the story has evolved in our favor. I think people can see today that many companies have the ambition of giving more value in financial services. But I think there's a very clear distinction between the first 4 or 5 years at Unit, in which we saw people basically, the early adopters, if you will, building with great effort, with great conviction. And these are very unique companies. So the companies, you look at the companies that launched financial services first, not even on Unit. You can see Toast or Shopify or Uber. These companies dedicated tens of millions at times, tens of people on staff. They've developed core expertise in all things fraud and customer support and how to do it from a compliance standpoint. And so I think when we first built the company and we served the initial demand, we saw demand of that type. We saw companies that still had the conviction and the willingness to invest because they knew that a lot of things were becoming possible if they have money features built in. And I think the first 4 years of Unit were defined by those relationships. You have companies like Honeybook or Wix or others that basically AngelList built on Unit. But I think what's changing, to your question, is that there's this notion of crossing the chasm in many markets, which is the first 10% of any market is those dedicated, maniacal, visionaries, and they're doing a lot and willing to invest a lot. And then you have the laggards and people who are the mass market. And I think what we are seeing in embedded finance now is that companies are moving from the initial set of convinced leaders onto the mass market. Now I think companies are asking very different questions about embedded finance. One is, what should I build? It's not just banking, like the Shopifys or the Ubers of 2019. It's also, should I build bill pay as opposed to banking? Should I, process payments and then launch capital first and then expand to other forms? So I think the forms of products that are being built have evolved. The second thing is I think companies are buying this and expecting the solutions to be much more plug and play. And this is very different from what happened in the past. People now are pragmatic. If you work at a company that competes with Toast, you want something much more packaged. So I think people are wanting to experiment and test and test the validation, but they don't want to do it with great effort. That's kind of what's changed. There's much more that's changing in the AI context, but we can talk about it if we find the time.
I think if we had had this conversation, 4 or 5 years ago, we probably would have done the intro and said, Unit is a leader in banking as a service. You really have kind of championed the use of the word embedded finance now. Just to put a pin in it, what do you see as the difference between banking as a service and embedded finance?
I think banking as a service is a pretty narrow term because it talks about banking. And I think, when we think about money as consumers or businesses, we think about Bill.com or Venmo. These are not banking products per se. These are just ways for you to store and move money. And so I think we wanted to change the conversation from banking, which is a very narrow term, into a broader term, which is how do you help people and businesses with money, tasks that they have. The other thing is that I think it doesn't really describe what's being built. It's like if you think about Uber, you think about getting from A to B. You don't call it, rides as a service or cars as a service. And so I want to think more about terms that are demand-centric than terms that are supply-centric. And so when we think about what's actually getting built, we think about these embedded finance, financial experiences that are embedded in context and help end users.
Okay, so we're not just talking about DDA bank accounts and cards linked to them. We're talking about the much broader umbrella lending and bill pay and all these other primitives. There's so many different things you can do. From my experience, many platforms start first with embedded payments. It's kind of probably the most developed of all of the flavors. It's been around for the longest. But that's really just the beginning. So from your experience, what comes next after payments? Of all the different things you could offer, what should you go about next? And also maybe how do you think about the revenue opportunity on those, and kind of what approach, what framework do you use to help you figure out, hey, there's 7 different things we could do that's under the umbrella of embedded finance, which comes next?
Yes. So I think it's important to start with the catalog. Like, what is the catalog? What is the taxonomy that you use to understand what's possible? What's the universe? We think about 4 money jobs that every small business has. Precisely 4. And for the longest time, even 500 years ago, small businesses had those 4 money pains. Get paid, manage your money, pay others, and get financed. This is what every small business needs everywhere, every part of the world, every point in history. So Unit thinks about the catalog. To your point, it's not just banking. It's not just to manage my money. It's also, how do I pay other enterprises? How do I pay my vendors? How do I allow my employees to get cards and spend? Many people spend with ramp cards these days, and they know that there's so much more that you can do around control and helping businesses manage themselves. So I would say that the 4 money jobs are timeless. We see payments as the money in, right? Rainforest covers the first leg, which is money in. That's the most obvious leg to start with. It's very natively integrated in many products at this point. And then the question is like, what's next, right? Do you want to drop the entire money hub on an end user? Do you identify a wedge within the other 3 levers? manage my money out, or get financed? Does any one of them seem like a better fit for your industry? And I think, with great regret, I say that we don't have the final answers. Like, it's not that I can drop the answer and tell everybody what they should do. I think it's very vertical specific.
Yeah.
But I can maybe give some examples. I can give you some examples that maybe demonstrate the different heat map for different industries. So think about a vertical SaaS that does e-commerce, that helps e-commerce businesses. That type of company is likely going to benefit from manage my money. So, Shopify launched a balance product. That balance product allows sellers to then spend on marketing, spend on inventory, and do it from within their Shopify balance, and maybe use different cards and different controls. So the heat map skews, money management when it comes to e-commerce businesses. If you think about a construction software company, I think the heat map skews money out. Because in construction, you have a lot of large, lumpy payments. They are typically in the form of checks at worst, and bank transfers at best. And many construction businesses have a vast network of subcontractors and sub-subcontractors. They need help moving money from the general contractor onto other bodies. So I would say that the heat map skews, help your customers solve a money out problem. And then I think about, companies that serve, we had one recent capital customer that serves laundromats. And if you serve laundromats with an all-in-one solution, often the owners of the laundromats want help expanding and buying more equipment, opening a new location. Capital is the skew in that case.
Right.
And so I think a lot of these companies need to see the heat map clearly. You need to understand what your end customers care about. And then what happens from there is that companies use that wedge to provide more and more financial services and eventually open the entire spectrum of financial services to their users.
That's a super helpful framework. So again, I think it's really depends on the vertical, right? Where do you have a right to win? And also how complex is the nature of those for money jobs? I think that's solid wisdom. Rubber hits the road. Are there any realistic expectations that vertical SaaS leaders should have? Realistically, what kind of revenue uplift are you seeing top performing platforms have? And also, what are the other ancillary benefits, right? Reduce churn, improve customer satisfaction, better stickiness, et cetera. But really on the revenue side, what are you actually seeing there?
So revenue expansion is anywhere between doubling revenue per customer relative to just payments to 5xing that component. You can look at the reports of public companies like Toast and Shopify and see how they think about the different levers. I can only talk about the questions that people need to ask. I can't give final answers, but the questions are, again, in the heat map of my customers, what they care to get from me, what seems like the hot area that might generate more demand that people might actually want to use. And then within that area, be it capital or paying out or managing one's money, what are the monetization levers? If you want to help businesses store money in your product, there's an excellent interest monetization lever. If you want to help businesses pay their bills, you can't really store money for them long term, but maybe you can monetize those individual payouts. So that if a company pays 50 bills per month and you charge $5 per bill, you can make $250 from that business. So I would say, again, it's layered because it depends on the type and timing of the financial services you want to offer. But each one of them comes with a calculator of some sort, and we make those calculators open source so that people can input the number of merchants they serve, the size of those merchants, and the product that they're thinking about offering. And then we can speed out the actual monetization, the size of the pie, and companies can choose how much they want to keep. So that's it at a high level. Retention is, to your point, is another big point. The 2 to 5x is a combination of direct monetization and increased retention, which is very, very important. And so again, in different industries, those things play different roles. But in all cases, we've seen software companies that launch financial services can expect to retain and keep customers for longer.
Yeah, that makes a lot of sense. I want to talk about something that we have discussions with our customers and prospects a lot about, which is moving the focus from the per unit revenue and expense side of things to the attach rate. you can't make money if you don't have customers using it. And so usage usually, in my experience, rules supreme over tweaking the individual rates, whether it's $5 per bill or $7 or $6 or whatever have you. Getting more usage is always going to trump those micro price optimizations. And I think that I've seen platforms kind of fall into two buckets. One is very much an afterthought. It may be a referral model, it may be a bolt-on feature. And then the others really dig deep and make this embedded finance product, whether it's payments or capital or anything else, a absolute core product function and feature. From your perspective, what steps should platforms take to cross that chasm, if you will, from this is a bolt-on afterthought to this is core product functionality, and we're seeing very, very high attach rates and therefore very high monetization?
This is the billion-dollar question of embedded finance and all embedded payments, embedded accounting, embedded insurance, every form of embedded product. I would say that the main question, the test, is basically, is a customer that's exposed to your financial services offering worth more than a customer who is exposed to your product without financial services, right? That's the key question that you have to ask. I agree with you. It's better to seek activation, which is a pretty binary number. Are these people getting value from payments? Are they getting value from capital, or are they not? If they are, there are many ways to optimize over time. If they don't, optimization is not going to help. So we think about those key numbers of activation or percentage of activation as the North Star for the deployments that we serve. Bolt-on means iframe. Right. Some companies adopt payments. I mean, I'm sure you've seen it in your business. Payments can be an afterthought. It can be a bolt-on. And so if you find yourself outside of the core product or outside of the core flows, creating an invoice or accepting a payment, that's a sign that the company may not take it seriously and might not think in an integrated manner. So all these are signs that companies are externalizing embedded finance. And our opinion is that we provide solutions that allow them to externalize. But to me, the playbook that makes some companies successful and other companies less successful is that it is actually embedded in the product. I think about success as default, invisible, and relevant. Default means that the more you can make embedded finance feel like the default payout destination, or in a case of a loan, once you accept a payment, there's a default repayment flow that gets triggered, the better. Right? If you make this so that the end user doesn't have to choose or compare or think too much, if you make it easy for them. When I say invisible, I mean, don't make people feel like they're switching a bank account on a Tuesday afternoon, right? Nobody does it. No small business is going to stop their life and close their Chase account and get what you call your new banking offering. You might want to promote it as, here's a balance. You can manage a balance within our software right now, and you can get paid into this balance and then do useful things with it. The invisible is very important. And then relevant is something that I think requires more thought, but I can't stress enough in companies that want to win. Relevant means that, it's not just another account. It's not a chase inside our product. It's something that makes our software better. And also our software makes this better. So if I'm managing a nonprofit, in some vertical SaaS solution, I have chapters of that nonprofit. Yep. If the number of cards or balances that I can see inside the money zone corresponds to the number of chapters I have, if my spend can be associated with a single chapter so that my accounting is more clean, if the people I add as my employees to the software get automatically enlisted in the financial services offering, that's a connection that people would actually buy, as opposed to something that is less relevant, right? It needs to be better than Amex. It needs to be better than Chase for you to have the right to win.
Certainly worthy competitors, 100-plus-year-old companies. That's what you have to best. All right, I like it. As you think about adding embedded finance products into the core platform, how should listeners think about the investment required? There's obviously the initial build and some integration, but what about the ongoing? I think that's something that I've seen in some cases people really overestimate and think this is a huge burden when maybe you're handling a lot of the compliance and things. I've also seen it go the other way. We've built it and we're never going to have to touch it again. And that's probably not reality either. And so how do you think people should think about the ongoing maintenance costs risks, etc.?
In 9 cases out of 10, I don't know about you, Joshua, but in 9 cases out of 10 in my career where I've seen people, misestimating, it's been underestimate. They underestimate the effort.
Yep.
So we've seen 100+ companies doing it initially on what we call the custom version of Unit, which is the involved version of Unit. Here's the Lego. You can build on the APIs. You can build on the white label components. And I think that it has 3 parts, like building any financial services offering, whether it's cards or loans or balances. It has 3 components that you must not underestimate. One is that you have to build them. The second is that you have to market them and actually drive adoption, to our previous point. And the third is that you have to serve the end user. If they have a question, if they are disputing something, you have to have that expertise. The bad news is that all of these are iterative. So they keep demanding as you learn, and they're ongoing. So you can't expect to get to the promised land of build. You can't expect to get to the promised land of driving adoption. And you can't get to the promised land of service. There's always going to be some demands on these fronts. And I think companies would be wise to be clear about what they can do. And I think about it as those 3 legs: build, market, and serve. It's too much for most companies. We've seen many people do what I call, trying to fly the airplane, buying the airplane and trying to fly the airplane.
Yep.
And I think you've seen it in payments too. Companies that think that they have the sophistication or the willingness to control more end up, defaulting to easier solutions or not taking advantage. And so we've seen companies taking off. We've seen companies doing, landings with airplanes and not discontinuing the products. And we've seen some companies that have been invested for years, but then eventually decided that this is not for them and had to shut down the product. All of this informed a very different implementation option that Unit offers in 2026, which we call Ready to Launch.
Okay.
This is a Unit managed offering. Whether you offer bank accounts, money out solutions or capital, it's yours to name what you want to offer. And it's on Unit to basically manage that program end to end, the build, the marketing, and the service with, of course, some help from you because you are exposing these products.
And so on a practical level, to make sure that we understand, with Ready to Launch, all of the compliance and the risk management, all of that sits with Unit, correct?
Correct.
And then from a technology perspective, rather than having the Legos and having to build the contraption yourself, there's embeddable components and frames and things like that are simple to kind of get started. Is that right?
Exactly. It's one of 2 things. It's actually, we do have components in that approach, but it's very common that whoever picks Ready to Launch actually puts 1 line of code in their product, and that 1 line of code expands into a full money hub. Now you can control if that money hub includes just managing one's money or managing one's money plus getting a loan or just getting a loan. You can basically switch on and off the different modules. But the approach that 90% of our customers are taking right now is that they want to buy the 1-line version of Unit, and they want that 1 line to live inside of their product. Some of them are actually choosing to allow us to host it all together. And that means that all customer communications, all of the hosting, of course, the actual build, the actual adoption, motion and marketing and customer service, all of that is owned by Unit. Now, you can optimize the experience. We have a bunch of APIs in the background so that even if you choose the low lift solution, you can still allow your code to pull transactions from the system. You can reward your customers in any way you see fit. But you're getting a lot of off-the-shelf wisdom across the build, the marketing, and the service.
Got it. It took Stripe 7 lines of code to process 1 payment, just 1 line of code to launch a full-blown money hub here in 2026. You heard it here first.
Progress.
Using that as a launching point, these days I think I'm remiss if I don't include AI in every podcast. So we're gonna throw it in before we wrap up. I'm sure you're seeing it as well. We're starting to see platforms that are using AI to automate financial workflows. Things like moving money, optimizing treasury, flagging cash flow risk, et cetera. What does a platform need to have in place before it's actually possible to use that AI? And also, how do you ensure your infrastructure and vendors can provide those types of automation so that you can actually build these really robust, automated, AI-powered, or at least enhanced solutions?
Yeah, so this is a big topic. Everybody is talking and thinking about it. I think, vertical SaaS leaders have their heads spinning from AI ideas and competition and dynamics. I think the best framework I've seen for assessing AI readiness is the system of record versus system of action. Have you read it by Tidemark?
Yep.
Tidemark is one of the prime VCs in vertical SaaS, and they've published an excellent framework that allows you to understand where you stand. Are you a dumb database, for the lack of a better word, or are you a system that your customers go to when they want to accomplish work? And they rely on you to automate their work. I think some vertical SaaS companies have positioned themselves extremely successfully over the years to be that system of action. Many vertical SaaS companies are actually in a disadvantage because they are more of a system of record. If you want an easy equivalent, I mean, you think about Salesforce, like a CRM is a classic system of record, but there's a million tools that help you accomplish work on top of it.
Sure.
Every vertical SaaS company, I think, needs to not just be the database,
Right.
but be the actual place that their customers go and do work. That's table stakes if you want to participate in any AI use cases or the AI economy. And so I think get your house in order, actually participate in accomplishing meaningful work. And then on the financial services side, yes, we're seeing a lot of demand for companies that want to allow agents to store money, spend money on behalf of a business, and help with reporting and other AI use cases. I think the best example that I've seen from our customer base is a company called Highbeam. They serve e-commerce businesses in, looking at all the shops you sell within, aggregating all the information, and also giving you banking services and credit that help you grow your business. They serve hundreds of large and growing brands. They built an amazing AI agent that can help you get answers to questions like, what's my marketing return this month? And it's all based on information within the financial stack. This is a trivial read-only use case.
Yep.
They're now launching and building agents that actually move money and help you optimize your cash. So agents, I think, are switching from becoming readers of information to writers into the lives of small businesses. And I think that having quality infrastructure that is AI ready and that LLMs can actually code against and implement use cases with is very important. And having the primitives is very important. I think the more Legos you have, actually, the more AI becomes possible because AI is excellent at taking the Legos and quickly making sense of them and assembling them.
Love that analogy. I want to do one quick segment before we wrap up. It's quick rapid fire round. So I have 3 true false statements about embedded fintech. Very quickly, tell me if they're true or false and why. Number 1, your payment processor is the same as your embedded finance partner.
False. I think there are many companies, the Stripes and Adyen's of the world that want to make you believe that it needs to be right and it makes sense. But what we've seen in practice is that both payment processing and embedded finance are specialized territories, and you will only check a box if you go with the embedded finance offering of your payment processor. You're actually not going to set your business up for success. I'll give you an example. We spoke to a very large public company about a year and a half ago. They process payments with one of the big companies, and that company locked them into exclusivity. They tried to convince them that they have the right building blocks for embedded finance.
Yep.
That company has never launched embedded finance with a big payment processor because it wasn't ready, it wasn't mature, and now they're opening things back up again and checking what the market has to offer. And so I think that there's a very real statement by the big payment processors, but it's a specialized thing, it's important, and it's difficult. So you have to go to the people that know about it best.
Fair enough. Statement 2, true or false? Platforms should wait until they feel completely ready to add embedded finance before starting.
True, but I would soften the completely.
Okay.
I think there are factors undeniably that affect one's readiness to offer embedded finance. I don't want to be here and try to convince everyone that they need embedded finance today because it's not intellectually true in all cases. I've seen companies sitting on that decision for a year and a half, and then coming back and actually doing it the right way. I would encourage companies to err on the side of doing it earlier because competitive dynamics, their scale enables that. I also think that if you make embedded finance default for your users, you actually end up getting a lot more adoption. And if you wait a year and a half, you're not going to get that cohort of customers that you're going to sign in this time. So I would say companies should wait and assess the opportunity. I've also seen many companies waiting too long and then coming back with their back against the wall, which is never the position you want to be. It's you or your competitors, typically.
Yeah, so it's careful Goldilocks problem. Not too soon, not too late, just right. All right, final one. And we already covered this, so if our listeners were listening carefully, they should know the answer. But true or false, platforms need to build their own compliance team if they want to offer embedded finance?
This is false. We have seen over the years the cost of compliance shrinking from a little bit of investment to now zero when it comes to, or close to zero when it comes to delivering embedded financial services. I'll give you a very trivial example for something you should never do. You should never mark on the dark web if you're a vertical SaaS company that offers financial services. This is trivial. This is on you. But everything that relates to servicing, answering complex questions, building a complex product, driving the adoption motions and the compliance that supports your embedded finance program, all of that should not be on your plate at all. Companies can choose to do it with zero compliance cost and basically put it in the hands of experts, like the approach that we're taking with the managed program.
Yeah, and I would add context. I think this is kind of a two-sided piece because from our, meaning Rainforest and units compliance, at least we've seen significant hurdles being added in the last number of years. Banks are cracking down. There's a lot more regulatory scrutiny and pressure than there ever has been. On the flip side, we're that buffer for customers so that they don't have to bear any of it. And so it's kind of on the one side internally going up, on the other side externally going down. And so, I often coach any platforms who think they want to be on the hook for risk. Do you really want to? Do you understand what you're getting into? Because in the meantime, since you might have done it 5 or 10 years ago, those costs and scrutiny and burden has certainly gone up.
I think it's very true. I think, if you want a simple equivalent, everybody used to host software on premise, then people moved to the cloud. They don't have to spend time thinking about cloud, but of course, AWS and Google Cloud do it for a living, and they obsess with those problems at scale, which I think is the equivalent of our companies. We are absorbing a lot of the complexity, but we are giving companies a much easier experience of actually building and scaling.
Well, Itai, we're just about out of time, and so I'll let you have the closing word here. If you had just one piece of advice for vertical SaaS leaders when it comes to expanding their fintech offering, what would you tell them?
Well, I said what I had to say about system of action, which is the generic piece of advice for any vertical SaaS company.
Yep.
I think in the context of money, I think what I would say is cash flow is king for all small businesses. And you would be very wise to lead with cash flow messaging and cash flow solutions. So if you are, thinking about what really bothers your customers day to day, most of them don't think about AI. Right. Most of them don't think about sci-fi problems that you and I are seeing. Most small businesses and medium businesses are thinking about staying in business. And you have to get into their head. And when you think about embedded finance, it needs to be in service of staying in business. And that means, managing my money better, delaying bills that I have to pay, accepting payments sooner, and getting loans, of course, so that if I have a cash flow crisis of some sort that is overcomable, I can take a loan and skip over that situation.
Very good. Thanks, Itai, so much for being with us. This was a great chat.
Thanks for hosting me.